I understand why Bitcoin went from 19,000 on March 13th, the week after the weekend of Signature and Silicon Valley Bank basically going into receivership. It was a flight to safety, 19,000 to nearly 28,000. That boy was that proof of concept right there. Decentralized, transparent, auditable, and so forth.
ARK Invest's Bitcoin monthly reports have revealed that while the U.S. banking system struggled with bank runs, Bitcoin, Ethereum, and other cryptocurrencies continued to operate smoothly. In fact, during the banking crisis in March, Bitcoin appreciated by 49%, from $19,500 to $29,150, proving to be a safe haven for investors. The demand for transparent, auditable, and decentralized financial services has soared as the centralized and opaque traditional financial system continues to show its weaknesses. Despite regulators blaming crypto for the banking crisis, the focus should instead be on the centralized points of failure in the traditional banking system. During March, Bitcoin facilitated approximately 9 million transactions, settled $650 billion, generated $700 million for miners securing the network, and attracted approximately 13 million new addresses. Even with the temporary depegging of USDC, the DeFi ecosystem remained resilient, especially the Maker protocol. Bitcoin's performance during the banking crisis outperformed bonds and gold, proving to be a safe haven for investors. The demand for more transparent, auditable, and decentralized financial services continues to grow, with crypto being seen as a solution to the issues of the traditional financial system. Cathie Wood remains strongly bullish on crypto, even though she disagrees with Balaji Srinivasan on his recent prediction of $1 million Bitcoin price within 90 days. In a new interview on the ARK Invest YouTube channel, Cathie Wood shares her analysis on the current markets and on the fragility of the banking system, which has further solidified the case for Bitcoin. Balaji Srinivasan, who recently wagered that Bitcoin would reach $1 million by June 17th. That's June 17th this year. He also shared some insight on his views and why he believed that Bitcoin would experience a crazy run to $1 million a coin. Before we listen to this explosive interview, please do not forget to smash the like button and subscribe to the channel if you are yet to do so. Thanks so much for watching our videos.
Many people had their money in deposits at the bank, and this crisis actually has forced them to focus on what they're earning in the banks versus what they could get into money markets. So you see them in their minds, what they're saying is, I am going to lower my risk by leaving the banking system and increase my return. Now, isn't that upside down? That's not how the world works. And this I worry about from a bank deposit point of view. And the reason for this is lending. And ultimately, lending is going to shut down. But what people have talked about, available for sale, you mark to the market right away for that, quarterly. So that hits earnings. Held to maturity, if you sell those, it hits equity. But what they're not talking about is the rest of the asset side of the balance sheet of these regional banks. And it's real estate, commercial real estate. 75% of real estate loans out there are, if they're from a bank, are done in the regional banking system. And I would submit that that residential will be hit in another way, because there has been so much overbuilding with the capital markets now facilitating this of multifamily homes that we have now coming online, the largest number of apartments in 40 years. So we were going back to the 70s, which was, so when I look at that, I said, okay, that was real estate speculation. That was inflationary. But I do think that rents will now come down dramatically, velocities coming down. And I, again, worry about GDP and economic activity.
Most banks have some amount of unrealized loss in security. How big a deal is that? Who the heck knows? The point is, though, that all like a flock of pigeons, the entire market has been spooked, right? Cash is now a risk asset. People are, moving to money market funds. People are, moving into big banks. All this money is now liquid. It's digital, and it's moving around like a cloud, and it's looking for the safest thing. And if some of that starts getting out of the system into Bitcoin, that is hyper Bitcoinization, right? Or it is Bitcoinization and then eventually hyper Bitcoinization, because it's looking for safety. And once it realizes, if it realizes that actually within the system there isn't safety and it starts seeking an exit, that's basically the thesis. All this money is being rendered super liquid and digital. And then what's going to happen is with something like Fed now, they're going to try to impose capital controls or blocks on it getting out of the system. So that's kind of my thesis, as opposed to micro things about what's going to happen over here. People don't think their money is safe in the bank. The assurances that people are getting are conflicting. They're like, oh, on the one hand, you're responsible for going through all of your bank's 10Qs. And on the other hand, Yellen is saying sometimes that they're going to back all deposits. You have basically not FDIC, but you have FedDIC, right, where all 18 trillion gets backed. The net effect of that is maximum uncertainty plus maximum liquidity.
Yes, I think, and so here we're back to the velocity question. Everything you have just said tells me velocity will go down, and that the risks to the economy are to the downside here, including inflation. So here we're coming to the same as we started at the beginning. I understand why Bitcoin went from 19,000 on March 13th, the week after the weekend of Signature and Silicon Valley Bank basically going into receivership. It was a flight to safety, 19,000 to nearly 28,000. That boy was that proof of concept right there: decentralized, transparent, auditable, and so forth. So we are on the same page here. I worry that that this economic downturn, this deflation, is a much bigger problem right now. And I do. If you're going to say, well, they're just going to throw money at it. We just saw that the Fed raised interest rates for the first time ever in the middle of a crisis. And today, this week, they've been talking once again about the need to increase interest rates at the next meeting. So I don't think they respect market signals. And this is a big problem. They are not looking at market signals. They're looking at massively lagging and unreliable indicators that are based on, in a world, the statistics came from the industrial age. So they're not even looking at the right numbers. Pricing signals are the most important signals right now. Credit default swaps, interest rates, yield curves, right? Bitcoin, yes, I agree with that. But I think you might have your hyper inflation of Bitcoin. And I think what we're coming to, if you seem to be nodding when I say what I'm saying about the banking system and the risks to the economy, it's not going to be inflation. It is not going to be inflation that we're worrying about this year. It will be something else. It may be counterparty risk, but I don't think it's going to be inflation in the prices of goods and services. And many people will say, "Oh, the dollar is going to collapse." Well, the dollar is measured. If you're measuring it in terms of prices and goods and services, right now, it's going up if you're looking at commodities, right? The dollar is appreciating. If you're looking at it in terms of other currencies, after a 25% run in a very short period of time, it's come down. But at the same time it's come down in the last few months, commodity prices have come down. So what does that tell you? During my discussion with Art Laffer last week, we were talking about Bitcoin, and he said, we really need to add, in terms of trying to figure out what's really going on out there in terms of the money multiplier, add Bitcoin to the monetary base, and we'll get a better picture. So he's already thinking in this way. And I was so happy that he said it. Half of the solution is understanding a problem and understanding how we should try and frame things to understand what's really going on out there. So this idea of adding Bitcoin, which is a little over 500 billion, to the 8.5 trillion in the monetary base, it was a start, and a start of a conversation, because we do have to deal with the world we're living in. The one you're talking about, I think will evolve over time, but it doesn't happen overnight. You might say the banking crisis is giving us that opportunity, and I think it may happen faster than otherwise might have been the case. But I am going to continue paying attention to market signals. I see credit default swaps settling down a bit. We haven't seen the regional bank index break down again, but it hasn't V-shaped either. So I think that's a risk there, that there's another episode. So we're watching all of this very carefully, and watching the stock market. Now, the stock market is very sensitive to all of this. And it is very interesting for me to watch the stock market levitate through all of this. And I think one of the reasons it is it smells the end of rising rates. It sees over whatever the Fed's going to do right now to much, much lower interest rates because of this deflationary pull from monetary policy and gone wrong, velocity falling, and that's the bad deflation side of it. But then you've got the good deflation side of it, as you said, and I always want to end on a very hopeful note. And the very positive form of deflation we're going to see, if we're right, is going to cause enormous growth in everything blockchain related, in all that innovation, as well as, the other platforms, the multi-omic sequencing, robotics, energy storage, and artificial intelligence. And they're all going to start converging. And, it's messy. It's messy getting from here to there. But I think, again, just the recognition of what can go wrong with the banking system, I think is going to cause more people to seek more insurance policies.
The recent failure of Silicon Valley Bank saw the price of Bitcoin soar above $25,000, a threshold it hadn't reached since June. Meanwhile, the U.S. government's debt is reaching unsustainable levels, and while politicians continue to kick the problem down the road, the Federal Reserve and U.S. Treasury Department are working hard to protect the dollar's position as the global world reserve currency. However, these band-aid solutions carry the threat of hyperinflation, and the global economic system seems set for a historic correction in the near future. Many within the Bitcoin community are questioning whether the fear of imminent hyperinflation is drawing investment back into Bitcoin. Could the recent rise in Bitcoin's price be a confirmation that the inflation hedge thesis, previously dismissed by many, is back in play? The fluctuating between rate hikes and quantitative easing is not addressing the primary systemic issue of expenditure significantly exceeding income in the U.S., leading many to consider alternative investments such as Bitcoin. As the global economic system faces an uncertain future, it's important to consider the role that Bitcoin and other cryptocurrencies may play in offering a viable alternative to traditional currency and financial systems. The rise in Bitcoin's price could be a sign that investors are recognizing the potential of cryptocurrencies to offer a more stable, secure, and decentralized alternative to traditional investments. What do you make of Cathie Wood's interview? Please let us know in the comments section. Thanks for watching.